And guys, it's Wednesday, September 24th, 5:25 a.m. Central Time. Grain markets are mixed this morning. December corn futures down a quarter cent at 4.26. November soybeans down 4 at 10.08. December Chicago wheat up 1 1/4 at 5.21 3/4. December Kansas City wheat up 1 1/4 at 5.12 3/4. December spring wheat up a quarter cent at 5.68. Welcome back to Grain Markets and Other Stuff. This is the best grain market podcast on planet Earth. This is also the best grain market YouTube channel on planet Earth. Mackenzie, it has been made, I've been made aware that of the people who watch on YouTube, about half of them have not hit the subscribe button. What should they do?
They need to hit that subscribe button.
If you guys watch, I know we've got a lot of newer viewers. Hit the subscribe button on YouTube. Help us out. We are very, very close to 25,000, which will be a big benchmark for us, big achievement if we can do that. Let's go back to Argentina, where we started yesterday. We've got some updates.
So China purchased a large volume of Argentine soybeans after the country suspended its grain export taxes, with traders reporting purchases of 10 to 15 cargoes for November delivery. The purchase came shortly after Argentina announced earlier this week that it would temporarily suspend its 26% soybean export tax through the end of October or until declared exports reach $7 billion. Earlier this month, reports indicated China had secured 15% of its November soybean needs, all from South America. In previous years, by this point, China would have typically purchased 12 to 13 million metric tons of U.S. soybeans for September and November delivery. However, China has yet to purchase any U.S. beans for delivery during the current marketing year.
This is soybean business that would have almost certainly gone to the United States if not for the trade war. Chinese importers must have made these purchases almost immediately when Argentina suspended that export tax. Reuters reported overnight that China bought even more. They're up to 20 cargoes now. So they're up to 1.3 million metric tons, or about 48 million bushels in purchases. One trader quoted in the Reuters piece said this: essentially, China will have enough beans without U.S. beans. Most of the cargoes are for November shipment, and around 20% are for shipment next year from the new Argentina crop that will be harvested from April. Now, I'm not sure how accurate it is to say that China will have enough without U.S. They bought 1.3 million metric tons when they would typically buy 20 to 25 million from the U.S. would probably be a fair number this year if there were not a trade war. So I'm not sure how accurate that is. One trader that they quoted said that China is likely to further accelerate purchases of Argentine soybeans to fill the procurement gap from November to January before the October 31st deadline for the $7 billion quota limit. So I guess that would imply that China will come in and in fact continue to buy soybeans out of Argentina. Now, to be clear about one thing, China is avoiding U.S. soybeans because they're fighting the trade war with the United States. If China really needs the beans from the United States, and the beans from the United States are cheap right now, they're competitive, China could waive the tariffs. China could waive the tariffs for its state importers. They could waive the tariffs for private importers, and they could let them buy the beans. But they're not. The soybean export program in the United States has some problems. A lot of other global buyers have stepped up, but China is such a massive buyer relative to everybody else. It's continues to be very much problematic.
So Chinese purchases of Argentine soybeans, they have sparked concern as the country's soy crushing chamber warns they will intensify challenges for domestic processors. Reuters reported last week that rising soybean exports to China in recent months have reduced local supply, pushing idle capacity at Argentina's major crushing facilities to 31% in July. The situation has led to fewer Argentine jobs and reduced soybean export value. Since the start of the U.S.-China trade war earlier this year, Chinese demand for Argentine soybeans has surged, driving exports from last season's crop to a 6-year high as China avoids U.S. supplies.
Okay, so the crushers in Argentina are concerned because the exporters are going to export a lot, and they're going to be left kind of with not enough soybeans, which brings me to this point. When there's a trade war, it does not add or subtract soybeans from the global balance sheet. And I threw up the global ending stocks to use ratio projections. I mean, we're fairly loose or bearish relative to history, but we're just seeing a game of musical chairs here. China's going to other global buyers, but supplies among those other global buyers are getting tighter. So it doesn't, the only thing that really adds or subtracts bushels from the balance sheet is really weather and demand or usage. And the Chinese demand is going to be, I think, typically what it it normally is. I don't know if we're going to see huge fluctuation. It's just we're seeing some musical chairs here. What it will do is it could result in a larger U.S. soybean carryout or ending stock situation. The projection, even with the reduced export program, is that we're going to be fairly tightish. USDA is projecting a 6.9% stocks to use ratio in the United States at the end of this marketing year. But in a perfect world, the way that this would work out is that other global buyers would step up to fill the void that China has left. It's just that the list of soybean importers is so skewed toward China. China is up here and everybody else is way down here. So China has the ability to kind of leave the U.S. Holding the bag here with regard to soybeans for the time being.
Grain markets rose on Tuesday amid optimism over a potential trade deal with China. The rally followed news that a Chinese trade envoy met with a delegation of U.S. political and business leaders from the Midwest, though no further details about the meeting were released. The December 25 corn contract gained nearly 5 cents to close near 4.26 per bushel, and the November 25 soybean contract gained 1 cent to settle at 10.12 per bushel. Kansas City and Chicago wheat futures also finished the day higher.
Details regarding this meeting, if it occurred at all, are very, very sparse. This meeting was reported initially by the Global Times, which is a publication in China, and the Global Times referenced a statement on the ministry's official website. Supposedly, Chinese international trade negotiator Li Changgang, who's kind of their main man when it comes to this stuff, was in attendance, and there were no participants listed as far as the U.S. Midwest delegation. We didn't really hear anything out of this from the U.S. side. I don't know if the meeting happened or not, but in any case, some of the news outlets, Bloomberg, namely here, citing this as a reason for the little bounce yesterday. And we did bounce. Corn futures, December contract kind of regained some trend support. Soybean futures bounced a little bit, but still looked very poor. So I'm not sure how real that is.
President Trump said yesterday that Ukraine could win back the land that Russia has taken. This is a big change from his earlier comments when he pushed for fast peace talks instead of a long fight. Trump's words give Ukraine and its allies new hope that the U.S. may support a stronger push against Russia. His statement also puts more pressure on Moscow, showing that the U.S. is not ready to accept Russia's gains as permanent. Many leaders at the UN were surprised by this turn. Since Trump had sounded more cautious before, the comments may spark a major shift in U.S. policy toward the war.
Trump spoke at the UN and they cut off his teleprompter after 15 minutes and then he talked for like an hour or something. In any case, I can't help but wonder in the back of my head if maybe this introduces an element of upside risk to the wheat market. We know that Russia is the world's top exporter of wheat. We know that back in 2022, when this war broke out, initially wheat futures spiked to extremely high levels. We were up into the teens and we're at, $5 right now. So if the conflict were to escalate and if the U.S. goes back into a situation where we're helping Ukraine in a more material fashion, I can't help but wonder if it introduces some risk. And I'll be curious to see how the market acts with this news. And we did bounce a little bit yesterday. Not really much action going on overnight.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Hardcore grain marketing information is what we did with Chris Barron yesterday. Cost of storage. What does it cost you in the real world to store grain on the farm? Whether you own the bins or whether you don't. Chris made some free tools available where you can actually punch in like, hey, these are the amount of bushels that I have. This is my interest rate. These are my other costs. And it'll tell you on a percent, like a cent per day basis, $1 per day basis, $1 per month basis, what it actually costs you to store grain. It's interest rates have become restrictive. A lot of things have become restrictive. This is really, really great stuff that you need to know. A lot of these costs are what I would call hidden, and you need to make them unhidden in order to kind of optimize your grain marketing. If you want to see the premium stuff, go to standardgrain.com. You could sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody will try to sell you anything else. As much as we love you guys here on YouTube, we would love it a lot more if you became a premium subscriber. YouTube is cool, but it is a giant loser for us. We lose money doing this show every single day. So check out the premium stuff, guys. I think you'll like it.
The USDA says it will soon roll out a plan to help rebuild the U.S. cattle herd. The language was included in a statement regarding New World screwworm earlier this week. Officials say this will make beef supplies stronger and keep food costs steadier for families. We don't have the details yet, but the plan could mean big changes for cattle producers across the country.
So this was part of this statement that was out on Monday, and I didn't catch it until yesterday. The quote was this: "In addition, USDA will soon release a significant plan to help rebuild the American cattle supply, incentivizing our great ranchers and driving a full-scale revitalization of the American beef industry. This is only the beginning, with many more announcements coming this week as USDA restores American strength, protects food security, and supports America's ranchers and farmers." Mackenzie, what are your thoughts?
This sounds like an absolutely terrible idea because I'm guessing it's government handouts.
Yes. Well, yeah, obviously.
Yeah, but I mean, so I'm guessing they'll just pay folks to retain heifers. And why would you retain a heifer right now when you can sell her for sky high prices and have someone else feed her? This is a
So this
terrible idea.
so this is something that you believe will hurt profitability for the cattle producer.
I wouldn't say it would hurt profitability, but no one's going to retain a heifer when you can make money selling her to feed her. I mean, yeah, some people will, but
Well, if they pay you to do it, I mean,
are we obligated then to keep the heifer? Can we just take the money and then also go sell the heifer?
I guess we'll
Like
find out
double dip?
when the details are released.
No, I just let things flow as they should. You don't need to intervene with the cattle cycle or the markets or anything along those lines.
A lot of people would say the same thing about the probably forthcoming farm bailout, but
Mhm.
that's a whole different topic that we've discussed at length. Let's keep going.
The EU will delay its anti-deforestation law for a second consecutive year after first postponing it last year in response to companies' complaints that the rules were overly complex. The regulation would ban the import of commodities such as soybeans and beef linked to deforestation or human rights abuses. The latest delay is attributed to administrative burdens and challenges with the EU's IT system.
The United States, we are obviously not involved in any sort of deforestation as it relates to corn or soybeans or wheat production. We've been pretty much flat with regard to total acreage for a long time. Brazil is a debate. The extent of Brazil's deforestation efforts with regard to soybean production and the expansion in acreage is debatable. Not all of the new soybean expansion involves deforestation, but some of it does. And when and if the European Union implements these new rules, there's going to be a cost associated with the regulations, and it's going to be absorbed largely by the importer in Europe, which could make things kind of messy on the export front. But this is a non-story for the time being until they put this thing into effect.
The U.S. economy is facing two-sided risks. On Tuesday, Federal Reserve Chair Jerome Powell cautioned that inflation risks are tilted to the upside while employment risks are tilted to the downside, creating a difficult path for policymakers. He offered no indication of whether he would support another rate cut at the Fed's upcoming October meeting. Powell noted that tariffs are pushing prices higher, though he expects the impact to be temporary. Meanwhile, recent data points to a sharp slowdown in job creation, compounded by a decline in labor supply tied to President Trump's immigration enforcement policies.
As we've discussed in the past, the Fed has a dual mandate. They care about two things: price stability, which is inflation, and then they care about employment. With regard to inflation, CPI is running at 2.9%. That was the last print. And the Fed has said over the years 2% is their target. What's interesting is that prior to COVID, they had trouble hitting the 2% target. Like, we were very often coming in below 2%. And now it's running too hot, and the Fed kind of sounds like it's conceding, and they're saying, hey, if we're 2.8, 2.9, you know what, that's cool. We're now more interested in the labor situation. Things are as expensive as they've ever been. We had this chart out the last time they did a CPI report. CPI, the Consumer Price Index, which tracks a basket of goods and services paid by urban consumers, is up more than 28% since February of 2019, pre-COVID. And the unemployment rate has risen to 4.3%. That's what they're focused on right now. That's the highest since October of 2021. Unemployment spiked following COVID, and the last time we were at 4.3 was when we were on the way down from the big COVID spike. So the Fed shifting its focus now. They're not so concerned about inflation, although Powell says that they are, but the policy and the cuts would say, hey, we're much more interested in the labor market right now.
USDA reported a flash sale of corn yesterday. U.S. exporters sold 5 million bushels of corn to Mexico. Of the total, 4 million bushels is for delivery during the current marketing year, and the remaining 1 million bushels is for delivery during the next marketing year.
Absolutely fantastic demand. I was happy to see the corn market bounce back a little bit yesterday. The export sales, shipments, all of it has been very, very good. What did cattle do yesterday?
Cattle futures were mixed. Live cattle were $1.55 lower to $1.10 higher. Feeders saw gains ranging from 77 cents up to $3.82. Box beef prices were lower. Choice was down 59 cents at $3.80.80, and Select was down $2.19 at $3.59.90.
Stock market's mixed. Treasuries are a little bit higher. US dollars higher. Crude oil is up 74 cents in the November WTI 64.15 last trade. Have a great day, guys. We'll be back on Thursday.